About a year ago, I heard about a company called Fundrise who advertised themselves as a public non-traded REIT. Now, I had never heard of a public non-traded REIT, so it kind of caught my attention. Was it better or worse than a traditional REIT? What was the difference? So I invested $1,000 with them, and this is going to be my 1-year review. So in this video, we're going to be talking about what exactly Fundrise is, what are the pros and cons of Fundrise as opposed to investing in a more traditional REIT, and then we're going to go and look at my actual portfolio and see my returns for the past year for Fundrise versus the REIT sector in general. If you're new to this channel is dedicated to all things personal finance related, helping you earn more, spend less, and invest the difference. Now, for anyone who's already watched a few of my videos, you know that I love real estate, I love REITs in general, especially if held within some sort of a retirement account. Essentially, all a REIT is you are buying shares, you're buying stock in a company, and that company owns real estate. So it's a nice passive way to get all of the benefits of owning real estate without all of the hassles of coming up with down payments and tenants and collecting rent and that kind of thing. So in Fundrise's case, they offer a little bit of everything. They have anywhere from single family homes up to mega apartment complexes. They have commercial properties, and they even lend out money and collect interest to developers who are trying to remodel these big, massive apartment complexes. So they do a little bit of everything. Now with a traditional REIT, these companies are publicly traded on something like the New York Stock Exchange, so they are very liquid. You can buy and sell these shares at the click of a button anytime that the stock market is open. But that's not the case with Fundrise. With Fundrise, you can actually only redeem your shares on a quarterly basis. This is a long-term investment with Fundrise. So if you're not going to be able to tuck your money away for at least 5 years and not touch it, then Fundrise is not for you. This is a long-term investment, whereas with stocks or traditional REITs, you can hop in and out of the market, potentially even multiple times per day. And with a traditional REIT, especially if you have a brokerage account that allows for fractional shares, you can begin investing with theoretically just a couple of dollars. Fundrise, on the other hand, does have a minimum investment, but that minimum investment is relatively low. $500 will get you into their starter account, and $1,000 will be able to let you pick one of 3 different core positions. Some are going to be more balanced on supplemental income, so higher dividends, lower appreciation. They have sort of a balanced fund, and then they have their long-term growth fund, which is going to be relatively low dividends, but the possibility for significantly higher appreciation. Now, obviously, future returns are never guaranteed, but if we look in the past, we can see that for the last, 5 or 6 years, we've averaged roughly about 10% return on your money per year when invested with Fundrise. But like I said, Fundrise is a very illiquid investment. So why would somebody want to invest in something illiquid like Fundrise when you could invest in essentially the same thing as a publicly traded REIT and have access to your money literally whenever you wanted it? Because ultimately that's the biggest difference, is that with traditional stock REITs, you can get your money whenever you want it, and Fundrise is going to be 5 years or more, generally speaking, that you're going to have your money invested. So why would you ever pick Fundrise? Well, it's true that liquidity has some very significant advantages, and because of those advantages, a lot of investors tend to obviously invest in products that are more liquid. So as they're funneling all of this money into these liquid investments, these liquid REITs, that's inflating the price and driving the price of these REITs up and up and up. And that's fine, except that as the price of the REIT increases, the yield is going to be very low in comparison. So think about it this way. Imagine we had 2 identical companies. One is a publicly traded REIT and the other one is a privately traded REIT. The assets that they own are exactly the same. And the returns, the dividends that they pay is also exactly the same. So let's just say the fair market value for both of these companies is $50 per share, and they each pay out $4 in dividends. Now, in the case of the privately traded REIT, that means about an 8% yield, $4 on a $50 stock price. But with a publicly traded REIT, since investors are typically putting more money into these companies, they're driving up the price. So instead of a fair market value price of $50, the stock price for this might be $60. And you're thinking, well, that's great, the price is higher. Well, but that means the returns are lower. So with a stock price of $60 and the same $4 return, now you're only looking about a 6.6% yield as opposed to an 8% yield with the privately traded company. So since you're not paying sort of this liquidity premium with all these publicly traded REITs, you're able to get essentially the exact same thing, but at a lower price point. And since you're buying in at a lower price point, that means your return on your investment, your yield, is going to be higher. And the second thing that private non-traded REITs have going for them that are not very liquid in nature is that with publicly traded REITs, when you turn on the news, you hear all kinds of different news going on of who's going to win the presidential election, is the Fed going to lower or raise the interest rates, what about the trade war with China? Like, all of this news affects corporate stock prices. So whenever you turn on the news, depending on is it a good news day or a bad news day, the prices in the stock market can vary dramatically just based on a news story that just recently came out. But in the long run, this one individual news story has very little, if any, long-term impact on any of these companies' bottom line. So these publicly traded REITs are very susceptible to various news and economic situations, whereas private REITs are much more stable. And this even happens in the stock market in general, not just REITs. For example, Berkshire Hathaway is notorious for never having split their stock price, and as such, one stock in Berkshire Hathaway is worth over $318,000 per share. Now, obviously, Berkshire could have done many stock splits along the way to lower the price per share down to something more manageable where you and I could actually own and invest in Berkshire Hathaway. But they don't want you and I investing in Berkshire Hathaway. They like this super high price point because it means that only ridiculously rich, wealthy people who are going to be investing for the long run are going to be buying shares in Berkshire Hathaway. They don't want me and you getting scared during coronavirus and pulling out all of their money needlessly and impacting the price of the stock. They're looking for long-term investors who are going to keep the stock price nice and level and are not going to get spooked by current economic situations. And I think investors are getting spooked when it comes to coronavirus and REITs. If we were going to look at a lot of these publicly traded REITs, maybe VNQ, Vanguard's ETF, VNQ is down, I don't know, give or take about 15% for the year. And if we looked at more residential and apartment complex specific REITs, maybe Avalon Bay, stock ticker AVB, or Equity Residential EQR, these stocks are down roughly 30-35% for the year. That's a lot to be down for real estate. The reason these publicly traded REITs are down is the general population is afraid that people are not going to be paying their rent, and therefore these REIT companies are going to be struggling. But according to the National Multifamily Housing Association, they survey all of the big market players, and they have 11.5 million data points. And roughly the exact same number of people are paying their rent this year during coronavirus as they were last year when everything was good. In fact, there's only roughly about a 1% year-over-year difference in people that are defaulting and not paying their rent on time. Now, when we're talking about a 1% difference in people paying rent, that doesn't make sense when we're talking about 30 or 35% decrease in stock price. And that stock price has nothing to do with fair market value and everything to do with fear. But with Fundrise, since you have limited access to your money, that means investors aren't suddenly just flocking and trying to sell their investment and get their money out. So since they are not, panic selling, the stock price in Fundrise has been very stable. In fact, where almost every single REIT that you can think of is currently down for the year, my Fundrise account is actually up about 5%. And that's a big difference when you're talking about something like Avalon Bay that might be down 30 or 35% for the year and instead being up 5%. Now, 5% return on investment for a full year, that's not exactly great, but keep in mind this is during the single greatest pandemic our generation has ever known. So simply not having lost money is a pretty good deal considering most companies are deeply in the red. So let's jump in and take a look at my actual Fundrise account and walk through some of the dashboard features. So here you can see that I'm invested in the long-term growth investment plan. This typically has the lowest dividends but the highest appreciation rates. Now, as you can see, my account is up $50.08 in the last year, so that's roughly a 5% rate of return. Now, about $23 of that was from dividends, and the other $27 was from appreciation. Now, if you'll look over to the right, you'll see the historical account value, and you'll see it in generally go up pretty much on a daily basis. And what that daily basis is doing is collecting those dividends. Now, you're not paid dividends on a daily basis, but those dividends are posted to your account on a daily basis, and they're actually paid on a quarterly basis. Now, if you want, you can have your dividends automatically reinvested for you, or you can have them sent directly to your bank account so you can live on it for living expenses, etc. In my case, I have my dividends reinvested for me. And the next thing you'll notice there is you'll see two fairly dramatic spikes in price. The first one is relatively small and the second one is obviously very substantial. And these are going to be when they do their appreciation calculations. So the first one happened on October 1st and the second one was on January 1st. Now, the one on October 1st is a lot smaller because I'd only been invested with them for a little over a month, so I didn't get the full quarterly appreciation rates that other people might have gotten. Now, you'll also notice that January 1st was the last big appreciation spike, so there was not one in April or July like you might expect. And I would assume that's because coronavirus has caused problems with the appraisal process and all of that. So I would expect that once everything is over with and they actually send their appraisers and their surveyors out to calculate things, that you'll see a very substantial spike in appreciation. Another nice thing is you can see exactly what type of projects you're invested in. So here you can see that I'm invested in 76 active projects with my $1,000 initial investment. 17% of those was in debt. So companies that are trying to remodel existing apartment complexes, they are loaning and collecting interest on that money. And the other 83% is actual equity. So Fundrise owns the property. They're collecting rent from the tenants and potential appreciation in capital value. And then you'll see down below how they grade their investments. They have sort of a proprietary formula that determines how safe an investment is. Now, generally speaking, the safer an investment is, the lower your returns are going to be. And so you're going to see it scattered a little bit throughout. There's a little bit of everything. And then if you'll look off to the left, you can actually see the various properties that you're investing in. So you'll see some new apartment developments. They've got some stabilized commercial properties. Down below, there's an apartment renovation. This is one that is debt, so they've actually loaned money out to the rehabber that is fixing up this apartment complex. So there you can see that this particular property is going to get a 9% rate of return as they collect interest on their money that they've invested. But with all of the equity positions, the properties that they actually own, obviously there's going to be a range where this is their total expected rate of return, counting both appreciation and dividend payouts. So as you can see, currently I'm up about 5% for the year, whereas most REITs are down anywhere from about 15% all the way up to about 35%, depending on which REIT you had invested in. So that's a pretty significant difference, and the primary reason for that is that Fundrise is an illiquid investment that is not subject to these massive price swings of all of the bad news that coronavirus has brought about. So obviously I'm relatively impressed so far with Fundrise. I'll probably be investing a little bit more money with them in the future. Now, like with all REITs, it is important to note that any income that you get from these REITs, these dividends, are treated as ordinary income for tax purposes. They are not treated as long-term capital gains. So that is one thing that you need to consider, especially if you are someone in the upper echelon of the tax brackets. That's why typically I like to have all of my REITs inside a retirement account so that all of the dividend growth is completely tax-free and I don't have to worry about that ordinary income tax bracket. So that's going to wrap it up for us today, folks. My one-year review of Fundrise has shown a 5% growth, whereas most REITs are down significantly. If you found this video useful, be sure to subscribe, leave a comment down below. I love hearing from you guys. And as always, I'll see you all again next time.